Hey there, and welcome to another tutorial. In this video, we're going to shortly walk through what a broken wing butterfly trade consists of and the reason why you would want to put on a trade such as that. If we take a look here and let's get a screen draw tool and let's think of a butterfly and let's think of a body here, and this is not going to be the best butterfly ever created. However, we're going to get the point here. So this is our lovely butterfly. Now, the butterfly trade consists of 3 legs. And the first leg, we've put a mark here, is going to be what the first wing is. And then there's the body, and then the other wing. Now, it doesn't visually look like a butterfly, but when you construct all the pieces together, you'll understand of how they get the butterfly spread. So really, the butterfly spread is depending on which side you play it on, the put or the bearish side, it consists of a vertical spread and a sold vertical spread. So let's say if we're playing an Apple trade, which I'll walk through, we'll look at Apple here and look at a trade that I initiated on Friday. So the trade that we're looking at here consists of the weekly options, and it was the 555. So this is the first wing here, 555 call, and then the 560. So this is the 560 leg right here. This is the body. And then the other side of the trade, this is the vertical, the bullish vertical. So if we break the trade down, I emphasize on this so many times. If you don't understand an option trade, they're very easy to break down. You understand what a basic option is. If you buy a call, or if you buy a put, or you sell a put, or you buy a put. That's the simplest way you could break down a strategy. Then when we start adding legs to it, then you want to understand what's going on. So just a basic vertical spread, we pay for this. Well, we're bullish from 555 to 560. We're capping our maximum profit at 560 to reduce our overall cost of what we paid for the 555 to create a spread here. So if we just bought the 555 calls, we could potentially be paying let's say $4. Well, if we sell the 560s, we sell those at $2. Well, we have, because the spread is 5 points wide, we take the 2 points that we paid, the $2 that we paid, minus the 5 points, we get $3 of profit potential. Now, yes, we're maxing our profit, but instead of paying $4, we reduced our cost to paying $2, and if we get the move that we're looking for, we'll have that move in a short amount of time. So the other part of this trade that we're looking at was a 560 and a 570. Now, a normal trading butterfly is going to look similar to this. But because the spread on this is 10 points wide compared to the 5 points wide here, the wing on this one is going to be a lot bigger. So I should have actually made this wing like this one. So it's kind of a lopsided butterfly. It was born with a longer wing than the this one right here. So this trade overall, this is the body of the trade, because now we're short 2. This is the body of the trade. We're short 2 here. We're long 1, and we're long 1 right here. So this is the body, and this is where the body gets the butterfly name at the body of the butterfly, because this is where you're looking for prices to stay at in that amount of time that you initiate the trade. So the trade that we'll look at is a weekly trade, and we're looking for just a grind or a potential move higher where prices likely have a good opportunity to hover around the 560 level. Now, the reason why we initiate a 570 is because an Apple trade like this, if we just initiated what's called a ratio spread, a 1/2, this is, again, the ceiling that we're looking at 560. And the reason that we would do a ratio instead of that 1/1, again, if we add on another leg, well, we'll reduce our cost now to, let's say we sold that, the call here was $2 at the 550, or the 555 calls were $4, and we paid $2 for this one to reduce our overall cost to $2. Well, then if we sell another one, we actually have a trade that we can put on for 0 cost. So we sold 2 of those, and we have a long exposure of 5 points up into the 560 level, where if prices don't exceed 555, we don't lose money, but anything into 555 into 560, well, we make a profit. Now, if it goes outside that 560 level, that's where we start to lose, because we are short this 560 right here. So that's the short end of this. The reason why we have this 570 here is because we want to, A, reduce the exposure that we have to the upside, not saying that Apple is going to gap higher. However, we want to make sure that we understand in any kind of position that we have our maximum loss potential. The other reason too is because if we're short a call, we're naked that call, and now we have to put up margin because we're short this one, and being short a call or naked a call, we're going to have to put up collateral. And a $560 stock is going to require a tremendous amount of money on margin, and typically an individual that will be able to do that is either an institution or somebody that has portfolio margin. Most of the traders that I trade with and coach with are not accessible to portfolio margin, nor do they want that. Nor do you even want to tie up that much money when you don't need to. So to create this ratio spread here, we just really want to do this 570 just to create the requirement minimum due to open this trade, which would be on a 1x2x1, the butterfly spread, the broken wing butterfly, that we have a 10-point cushion between this. And this is what we would have, $1,000 of collateral instead of having many more thousands in collateral because we're short the naked. So that's the reason why we would do it. But if we break it down and just focus in on what the bullish position is, if we put this on the call, what we're looking for is a move into 555 to 560 and prices to hang around 560 where I would say really short. That's the body of the trade. That's where we're looking for those prices to stay at. So if you have the visual here, we'll take a look, go look at a chart, look at the trade that was initiated, and break it down. So when we look at this trade here, the trade that was initiated on Friday used the 555, 560, and 570. And what I will do is I'm going to break this down to just a 1x2x1, just the basic minimum trade that we could put on, 1x2x1. Now, if we look at this, 555 to 560, again, if we visualize it, looking at it from left to right, this is the butterfly body right here. Get my screen draw tool. Again, this is the butterfly body, the call side, and these are the wings. This is the wing right here, and this is the other wing, and this is the wing that we're just using to reduce the margin cost. This is the only thing that we were using this 570 for. That's the only reason that we're having the 570, is just to reduce the margin cost. This is a reason for a broken wing butterfly. The broken wing butterfly, again, is just the wing is spaced wider than a traditional butterfly, and the reason why the spacing a little bit wider on the direction that you're looking for to move is because typically you will get a credit. Now for this trade, I actually was able to get a 10-cent credit at the time. You can see here on a 1x2x1 we get a $9 profit because of where prices closed. Now we're looking at the options here, and these contracts were the March weeklies with 7 days to expiration. Now if we look at a chart of Apple, the strike selection that I'm picking is about $15 out of the money. Now there's a few different reasons why I'm looking at this position and putting it on into the weekend. Time decay is a factor. Also, just the overall potential move of Apple could be a nice catalyst coming into a Monday. We have two benefits of using the weekly options where, again, we take a look at what we're short here. We're short the 560s. Well, these are out of the money options. Out of the money options typically are going to decay, just like every other out of the money option. And we're going to get the benefit of having short these 560. And at the same time, we have the benefit, yes, we have the 555s that are going to depreciate as well in the 570s, but the overall trade we take in 10 cents. So we're not really worried about that overall decay because we have a trade here that is going to benefit if prices do move higher. At the same time, we're taking a directional bet where we're taking in a credit. So if prices do not move at all and actually move lower to 500, we still take in 10 cents. So we have the directional aspect to the trade. At the same time, we have the potential to still make money if we do not see that price move that we're looking for in the next, at this time, 5 days. So the reason I picked that strike selection, and then we'll just quickly walk through this, is looking at standard deviations. How to get that standard deviation is what we take is the 545 price, and we times it by the average implied volatility for that contract. So this weekly contract, the average is at 25. So we times it by 0.25, and then we divide it by 16, which is the number of trading days, the square root of number of trading days in a calendar year. So what we get is about an $8.50 one standard deviation move in Apple. That sounds about right. If we look at Apple and we look at, Friday's not a good example, but if we take a look back, Apple typically will move about $8.50. That's a typical one standard deviation move on Apple. So with that, my strike selection is just about 2 standard deviation moves. Now, is Apple going to gap up about 2 standard deviation moves? Not likely. But if we do get a move of 1 standard deviation, our trade will actually profit and have a nice little return. Reason being is that those 555s will increase in value. The 560s will likely, because they're out of the money, not increase as much, and the overall trade will actually turn from a credit into a debit, which is what exactly we want. We'll look at the 560s here, and in Thinkorswim what you can do is you can open up, they have already traditional settings where you can open up specific trades. What we're opening up here is a butterfly. This is a normal butterfly. Note the spacing here, it's 5 by 5 by 5, and what we're doing here is we're opening it up to 570. Well, notice here it closed at a 1 cent credit, but we're just going to move this back into a 10 cent of where this trade was initiated, and we're going to go to the Analyze tab here. So I'm just going to make sure that I do not have any other trades loaded in here. So right here you see the butterfly trade here. We have a 10 cent credit. The red is what our trade would be profitable at expiration. Notice at 560 at expiration, we stand on this contract size 10 by 20 by 10 to profit about $4,000. This is our max profit here. The max loss at expiration is anything past 570, we're losing about $4,700. So just nearly $5,000. Our profit area is in this cushion where we profit. Actually, the profit area is from anything to the left here. So anything, if it went to 0, we would still make a 10 cent profit. But where we start to see the spike in prices and profit is when we start getting into what would be at expiration anything between 555 and the 565-ish area. It's about 562.50. The white line here is what prices are, or what the pricing of the options are right now. And as let's say right here we have 545. Let's open up prices here at 555. Actually, let's do 550, and let's move it into Monday. So right here, we don't really see a profit here, but the things that we'll have to work on take away some of the time decay that is in this option contract, which is not really letting us do it right now. But what would happen is we would see this curve start to widen into our profit. So with the time decay that would occur and with that kind of move, we would start to see a profit move higher here, and we could start seeing where the 1,000 would try to will return here. So if we move prices up a little bit and we move into where expiration would land, which is going to be on the 16th, and we start to move prices up here, the pricing of those options or this contract would actually start to, this white would start to increase here. Now, the Analyze tab does not take in the whole consideration of how these options are priced in the weekly time frame, so it's not giving us a real good analysis of what it would look like. But what we want to look for, and the reason why I'm putting this position on, is because that time decay that does affect those options on the weekly cycle, even though these aren't a monthly cycle, with monthly expiration this month, that's what we're looking for on that. We also look at a chart here. We look at recent highs. We're just right off of recent highs, which is right about that's about 550. So if we get a move into resistance, we'll likely see a nice profit, and we also at the same time will see a nice profit if prices do move into that level, and we look at that standard deviation. So overall, this is a not very bullish, because we still have an opportunity to profit and we don't have unlimited profit, which is fine. At the end of the day, we want to structure trades that we can benefit on being able to profit and also be wrong and make money at the same time. Being wrong is that prices do not move that aggressively, or prices actually move lower and we still make money. The broken wing butterfly trades are actually a very good trade for those that are not actively trading throughout the day. It's one of those trades that you could set, let it work for you, and you not have to watch the market all day. Come in, have some alerts set, and look to take your profits. There's a lot of these butterfly trades that I put on each and every week that I just set, and when I come off the weekend or look at it at the next day, it's something I'm not actively tracking. I look back and I close them out for a nice, if they have a debit, I either let them expire. I'm sorry, if they have a credit, I let them expire, but if they went from a credit to a debit, then I'd close that out for a nice profit as well. So these trades are really nice. Apple was one that we went over last week in the members video, and that one just really cranked out some profits going in at 545, which is that short strike that we're looking at going into this week. So hopefully that helps you understand more about the broken wing butterflies, the reason why I put them on, and something that you should incorporate into your own trading strategy.
After you subscribe to the channel below, make sure you head over to optionsizzle.com and download my free report on how I outline the process of finding options that are on the verge for explosive moves.